Hello, Smarties, and thank you for joining. This is Thrive in 25 series of webinars. This is webinar number 1, talking about unlocking passive investment. Today, we're going to be talking about alternative investment, leveraging equity and debt strategies. Our agenda for today is going to be an introduction to alternative investments. We're going to talk a little bit about equity and debt strategies when investing in alternative investments. We have a couple of investment opportunities for you to review as well, and would like to answer any questions that you have. Just as housekeeping, during the presentation, if you have a question that you want to ask, feel free to use the chat function, post your question in there. I'll be monitoring the chat function and will interrupt the presenter if the question is deemed important. My name is Addy Saeed. I'm a registered dealing rep with Westcliff Corporate Finance, which is a division of Waverley Corporate Finance. Waverley is a registered exempt market dealer in the province of Ontario. For the past 20 years, I've been a real estate broker and a real estate investor specializing in investment real estate. With me is my partner, Jaffer, who's also a registered dealing rep with the same credentials and has over 20 years of experience in real estate finance, accounting, and capital markets, spanning both Canada and the US. Westcliff has an ethos of learn, invest, and manage. So I wanted to give you a bit of a breakdown of what that means. In the learn bucket, we like to empower our investors and our clients and people that we connect with through education, which comes through sharing clear and comprehensive information. We have a couple of different buckets that we use for that. We have Smart Real Estate Podcast by Westcliff. Wherever you listen to your podcast, you can subscribe to it, or you can go to westcliffam.com/listen to get the latest episodes and find all the links to subscribe. We have our Westcliff Investors Network, which is a group of fellow investors where we share information and allow you to network with each other and put deals together. And we also have webinars, much like this one. We also do one-on-one consultation. Once you have been empowered enough through the education, we ask you to come and invest with us. And what we try to do is help you make smart and informed decisions. We identify opportunities that suit your financial profile, risk tolerance, and investment objective. And we only offer well-researched real estate equity and debt products. You can book an appointment with us by going to cal.westcliffam.com. And the third bucket we have is manage. If you have an asset that you need help with managing, this could be a real estate asset, we can help managing that asset. And we also, all of our offerings over here come with reporting either on monthly, quarterly, or yearly basis that provides you with an update on how your investment has been doing. If you'd like to learn more about that, you can check out www.westcliffam.com. Let's talk about investing. So there's generally two ways of investing. There's active versus passive. Anybody that is joining our call here have done a transaction in their lifetime. Whenever you're buying real estate, there are certain steps that you go through. You go and get approved for a mortgage. You identify a location, whichever city that you want to buy in, and the type of asset that you're looking to buy. You're buying a multifamily. Are you looking to buy a commercial, retail, industrial? Once you find an asset that you're interested in, you submit a purchase and sale agreement, and you talk to a lender, and you take on a mortgage to purchase that asset. The next step is either you're assuming existing tenants, or you're going out and doing some renovations and finding new tenants. So there's investments that you're making into that asset. And then you're holding that asset and hoping to sell it for a profit. There are pros and cons to investing directly. The pros, first one is direct ownership of the asset. You own the asset directly. It's in your name or in one of the corporations that you have 100% control over. You have the ability to leverage your investment. You're taking a mortgage on that asset, which means that you were able to leverage the initial investment that you made. It could be 1 to 5 or whatever percentage that you got. You were able to leverage that investment and purchase a larger property than your initial investment total was. You have the option of doing equity takeouts once the property appreciates in value, and you can generate the highest return possible for that asset. On the con side, it does require a larger initial capital investment. So you can't go and buy a property unless you have a substantial down payment available. It requires you to take on debt. There's risk involved whenever you're making a real estate investment. If you're doing a value add, obviously the property is going to require a larger down payment, but then you also have contractor risk. You have the city approval risks. You have expenditure risk, your expenditure budget risk. It also requires active management. It takes time and energy from your side to realize whatever profit that you're projecting. The last one is the return potential is limited to that one asset. And that could make you feel like a big fish in a small pond. You could be doing some great things, but you have a limit on how much return you're generating. Now, if you were to take that same active investment and convert it into a passive approach, what would it look like? So instead of having to require a large initial investment, what if you could invest with only as low as $5,000? What if instead of taking on debt, you didn't have to take on any debt? You just make that investment that you have to make. Instead of having to deal with tenants and expenditure, the property was professionally managed and all the accounting was done professionally and sent to you in a report on a monthly basis or a quarterly basis. You didn't have to spend your time and energy to manage it. It was actively managed by somebody else. And then the investment was actually diversified, not only in that particular asset, but into multiple assets from multiple types of assets. This is alternative investments. It's a non-traditional investment option beyond stocks and bonds, including real estate and private equity. Alternative investments are private and exclusive offerings which can be layered into your existing portfolio. With that, I'm going to pass it over to Don McDonald, is the founder and president of Waverley Corporate Finance, which is our exempt market dealer. We're licensed under Waverley, and Don is going to talk about why in alternative investments. Don?
And why not?
That's
Thank you. Thank you guys for having me. I always like to talk about what we do. You can flip to the next slide. Just quickly, I've been active in the Canadian capital markets for 40 years. So I enjoy working with kids like Kaz and Addy. They make me feel young. I've seen the financial markets from a number of different sides. Founded Waverley about 12 years ago. In that period of time, we've grown to the largest exempt market dealer in Canada. And I'd like to think we've done some things right for our clients to get into that position. We take great pride in partnering with true industry professionals like Kaz and Addy and have long-term relationships. So I'm going to talk briefly about alternatives, elevated a bit because we're here to really talk about real estate, but talk about alternatives in general and really compare them to the alternative to alternatives, which is the public markets, and some of the travails and some of the risks that people undertake investing in the public markets they're probably not aware of. So most Canadians are very heavily overweighted in Canadian public equities and bonds. And that's because the wealth management business in Canada is controlled by the banks and life cos, and that's the assets that they can offer. This is a chart I'd like to show people. Tiger 21, if you're not familiar, is a ultra high net worth investment club in North America. There's about 500 members. You need a minimum net investable assets of US $10 million to be a member, and the average net worth of a member is around 100 million US. And this pie chart looks very similar to a lot of the big pension funds, endowment funds, what I call the smart money. And if you look on the bottom left there, you've got public equities at 21%. So most Canadians are going to be between 70 and 90% of their portfolio in public equities. And you'll see the majority of their wealth is in private equity and real estate. And there's good reasons for that. So we can go to the next slide. And you'll see, just comparing the alternatives to the public markets, advantages for alternatives, higher risk-adjusted returns. Very simply, for a given level of risk, you can make more money. Better protection of principal. There's a better opportunity to build security into an offering, better cash flow, and they are much less volatile. The advantage of the public market is liquidity. But as you can see, the imbalance in this slide, that liquidity comes at a pretty big price. This is just a chart of the S&P TSX 60 in 2023, I think. And it just shows the volatility that investors had to endure to end the year 1.9%. So when I say low risk adjusted returns, this is a pretty good graphic representation of it. This is a great slide, and I won't take too long, but this is Centurion REIT is one of our long-standing issuers. We've raised a lot of money for them over the years. They're over $7 billion in assets, and they basically have a very large apartment building portfolio. So they buy buildings, they fix them up, they increase the asset value, and they flow the cash flow and the increased value through to investors. Very conservative, very low risk way to invest in real estate and diversified over a number of buildings. This chart is from, I think, August 2009 to August 2023. And it shows, you can see Centurion REIT in the top left. If you can draw, And what this shows is return on the y-axis, so 14% at the top, and risk as measured by standard deviation on the x-axis. So you'll see where Centurion REIT is the only asset class that's on here that has the same risk profile as Centurion is government bonds. So that's the type of volatility we're looking at. And if you compare it to, again, I like to compare to the S&P 60, which is here. So if over the same period, the S&P returned 42% less than Centurion, and for that, investors had to endure 140% greater risk. But note, this chart starts in August 2009, so it's a year after the crash. They're starting at a period where the public companies are never going to look better. If you take this back another year, the public market returned on average of 3% a year. And another thing that's very telling about the public market is no broker is ever going to tell you what your returns are on a risk-adjusted basis. So if people on this call, like me, lost money in 2008, had I listened to my broker and he told me, just stick it out, the market always comes back. And that's absolutely true. The markets always come back. But had I taken that advice, I would have broken even on an inflation-adjusted basis in January of 2024. That's essentially 16 years out of the market, losing money to inflation. Our investing life is not that long. We can't afford to take 16, 20 years out of the market. And 16 years is one of the shorter recovery times if you go back to corrections over the last 100 years. So people generally don't know this type of information and the risk that they're taking with the public markets. You can go to the next slide. And just another thing that people generally aren't aware is active management in the public markets fails, and fails every time. And this is 1 to 10 year performance charts for Canadian money managers. And you'll see the red is the 10-year number. It's across the board, 90, 95% fail to beat their own indexes. So we're paying this industry top dollar to fail. You can, if you want to invest in the public markets, I highly recommend just buying an index fund and pick your asset allocation. And this is just I'm going to steer us back towards real estate and why it's such a great asset class. And we've gone through a bit of a rocky patch recently. It's very hard for any industry to manage through a 400 basis point increase in rates in a short period of time. But if you look at the fundamentals, this is just a population chart. Most people are aware of this. And if you flip to the next chart, Addy, this is our housing deficit in Canada. So this is it's a massive deficit. We're going to have excess demand for housing for the foreseeable future. Frankly, the numbers that you see here in that deficit is not a fixable problem. We would need, if we doubled the amount of construction trades in Canada, it would still take 10 years to solve this. So we really have very strong demand on our side. Interest rates have come down over recent months, as everyone sees. Cost of debt's going to come down. So the environment for real estate is really on the upswing, and really a good time to take a closer look.
Thanks, Don. I really appreciate you taking the time and walking us through it. If anybody has any questions, feel free to post your questions in the chat. Next, we're going to have Kaz talking about leveraging debt and equity strategies. Kaz?
Yeah, thanks, Addy, and thanks, Addy and Don. So let's talk a bit about some of the key benefits of private alternative investments. There's 3 major benefits. Number 1 is around diversification. As Addy pointed out earlier, when you invest actively or directly, you're going to be exposed to one particular asset. With alternatives, you have opportunity to be able to have exposure to a pool of assets, many of which would be difficult for you to invest on your own on an individual basis. Secondly, around passive income. So an opportunity to be able to earn returns without having to do the heavy lifting of managing the property, collecting the rent, paying the debt. More so you're actually getting paid for your investment, whether through interest, dividends, or capital gains. And finally, from a long-term growth perspective, by investing in an alternative investment, you're benefiting from the upside appreciation of that asset, having your capital work for you over time. Some of the risks to consider, just like any investment, you're going to be exposed to different kinds of risks. As Don pointed out earlier, one of the biggest risks in the public market, you saw that chart with the volatility, which means how your investment goes up or down over time. Headlines, TSX has gone up by so many points or gone down by so many points. And that's really, a lot of that's driven by what we call market sentiment. How do people feel about the market? When you think about alternative investments, the underlying investment itself is actually valued based on the asset, not so much folks' market sentiment. Secondly, it's around access to capital. So as Don pointed out, one of the big benefits of the public markets is being able to have access to your cash. When it comes to alternatives, depending on the type of investment, your money may have to be locked in over potentially even a multi-year basis. So we'll talk about some opportunities a little bit later. If you think through a real estate development, your equity or your cash would have to be locked in so that developer can complete the construction over a multi-year period. Finally, project-specific risks. So by picking certain alternative investments, you're exposed to the risks of that underlying asset. So for example, if you invested mortgages through a mortgage investment corporation, the risk of those underlying mortgages are something that you are exposed to from that standpoint. Equity versus debt strategy. What position in the line do you want to be in what we call the capital stack? So an equity investment would be where you actually participate in the upside of that asset, or even the downside, quite frankly. When you invest in an asset, you benefit from the profit sharing, the capital appreciation. Versus a debt investment, you're actually lending your money, which is then being used to, say, service debt or make other investments, or very common here would be investing in mortgages, for example. And so that the income, you are basically the lender. And so the income that you're benefiting from is the interest that you're getting from those investments, as well as any repayment of your original principal. So how do you invest in alternatives? We've mentioned a few times, you've probably picked up on the call, that both Addy and I are registered dealing representatives. So that there is a whole compliance regulations around that. Addy and I had to go through a series of qualifications in order to be certified as dealing representatives. We work with Waverley Corporate Finance, which is, as Don pointed out, the largest exempt market dealer in Canada. And so Addy and I work directly with Waverley to be able to offer different alternative investment products. Both Addy and as well as Waverley then are regulated through different regulators. In this case, in Ontario, it's the Ontario Securities Commission. So there's actually 3 levels of compliance, really, to make sure that the interests of the public are being protected. So whether you decide to proceed in a further conversation with Waverley, Westcliff/Waverley, it's important that whoever you're working with, ensuring that they are a registered exempt market dealer and you're working with a registered dealing representative. So let's talk a bit about what is the role of an exempt market dealer and the dealing representatives to, again, protect the interests of the public. So there's 2 processes, and I did extensive exams to have to be able to certify and show that we understand how these processes work, but they're called Know Your Customer and Know Your Product. So step 1 really is knowing that customer. So you as a potential investor, different investments can fit different people depending on their objectives, what they're currently invested in, their time horizon, and quite frankly, their tolerance for risk, which is a very common conversations that we have with a lot of investors and prospects. And so there is a level of KYC, or Know Your Customer, that we as dealing representatives have to undertake. It's regulated. And Don and the Waverley team also does a next level of Know Your Customer, just ensuring that before you move forward with an investment, there's been a suitable amount of work that's been done on that side. The second side is really around knowing your product. So there's 30 plus offerings currently on the Waverley Corporate Finance shelf, and a number of steps that are taken through due diligence and compliance that's done to ensure that those will, again, protect the interests of the public, both today as well as in the future. And then that due diligence doesn't just stop at the exempt market dealer or the dealing representative. We recommend that you should be doing your own due diligence. At the end of the day, this is your hard-earned wealth. This is your money. You want to be able to make sure you get comfortable with where you're placing your capital. So to put this together, this is a bit of a sample checklist. As part of a consultation, obviously, we would go into a bit more detail. But just to give you an idea, number 1 thing, we mentioned this earlier, is assessing those credentials. So if you Google Addy or I, you'll be able to see that we're actually registered dealing representatives. That's all available in a national database. You can see Waverley's credentials, ensuring that they are an approved exempt market dealer. So that's your first. Are you dealing with someone that's regulated, that's approved? Then your next level is really diving in. The next 3 points are really around the investment itself. So what's the quality of investment? What's the track record of the sponsor? Do you understand what they're investing in? What do the returns look like? What are the risks involved? And finally, in your portfolio, because the way we look at alternative investment, You can have your existing public market portfolio or with your stockbroker or your financial advisor before you dabble into alternatives. Look as an overall universe in terms of helping you meet your investment objectives. Of course, making sure that and checking with your EMD and your DR or dealing representative, has the KYC and KYP processes been undertaken, ensuring that those processes are being followed. And then finally, be curious and always ask our clients, hey, have you looked at the agreement? If you've never signed one of these investor subscription agreements before, retain a lawyer, have a look, maybe talk to an accountant to understand the tax treatment that may impact you. Really, before you make the trade, because once you sign the trade, you've moved the cash, it's very impossible to go back. So that's a simple. So how do you invest in alternative investments? So number one, this is tax time. If you haven't noticed already, we've got our RSP deadline coming up here March 3rd. I can't believe it's 7 weeks away. And so if you've got some RSP room to use, that could be an opportunity. Also, everybody in 2025 has an additional $7,000 in TFSA room. If you've never contributed to your TFSA, that's $102,000 available to be able to contribute and grow tax-free. You'll obviously want to make sure, and we'll talk about this shortly, depending on which alternative investments you invest in, some are registered funds eligible and some are not. And so you want to look as part of your strategy, do I want to use up my RSP TFSA room? Do I want to keep it outside? That's something that you need to consider as part of your strategy. Then complete your due diligence. That's step 2, which we just talked about. So doing those steps to protect yourself as you move into an investment. Number 3, then complete that trade, transfer funds. And then of course, number 4, people sometimes miss this, but just place capital, that's where the journey really starts, is monitoring the performance of that investment, seeing how that's performing versus your portfolio. And then very commonly, it's readjusting your allocation and looking how things should be invested. Okay.
Thanks, Kaz. Really appreciate you taking the time and going through that. If anybody has any questions, feel free to post your questions. Next, we're going to go through some of our offerings that are available right now. So I'm going to hand it back to Kaz.
So what we've done here, as I mentioned earlier, through Waverley Corporate Finance, the Zep market dealer, there's over 30 alternative investment options that are approved, have gone through the necessary levels of due diligence. What we've done for the purposes of this webinar, because this is more of an introductory webinar to give you some perspective on alternative investments, is we've picked 4 different opportunities. The first one is an apartment fund. Then we picked an industrial fund, a debt or a mortgage fund, essentially, a mortgage investment corporation or MIC. And then finally, a real estate development. So you get a nice little cross section. So with that, and actually all 4 of these you're going to hear about, they're all registered funds eligible for consideration for you. So let's dive into Centurion as our first one. Centurion Asset Management is a bit of a household name. Many folks may have heard of them. They've been around for over 20 years, a whopping $7.4 billion of assets under management. This particular apartment fund has actually been around since 2009. They're targeting 7 to 12% annual returns. And your returns, basically, when you're investing in this apartment fund, you're actually gaining exposure to investing in 158 properties across Canada, which most of us on this call would not be able to buy 158 properties. So the power of investing in a fund like this is gaining exposure to those 158 properties, not taking on additional debt, and then receiving either a monthly cash distribution, or you can sign up for what's called their DRIP or Dividend Reinvestment Program. You may not need the cash. Maybe you put money in place in a TFSA and you don't plan to withdraw for another few years. You may want to have your investment actually grow further by, instead of receiving cash distributions, just buying more units. And what Centurion's actually done, which is a very common thing to do and a really nice incentive, if you elect for the DRIP program, you can actually buy units at a 2% discount. So now that $1 distribution just goes that much further for you. Again, as we mentioned, this is registered funds eligible. And the minimum they're looking for from an investor is $25,000. So a fairly modest amount to get in there, get some exposure, and then be able to grow from there. As we talked about earlier, there's a significant housing deficit in Canada. And so being able to get exposure to multifamily allows you to really add that to your portfolio.
Yeah, we did get a question asking, is this Scott McGilvery's fund? So in short answer is no, this is not Scott McGilvery's fund. The tranche has closed now. This is Centurion. They are a behemoth in Canadian real estate investment. Their fund, as listed, is 7.4 billion. And there it actually tells you there's 132 multifamily apartments, which make up 81.9% of their portfolio. They also have student communities, that's 10%. They also have 10 medical offices, which is 2%. And they have 43 funded investments, which are equity investments and mortgages. So what they're doing is actually going out and investing into other developments and probably getting an option to purchase them to feed their giant machine that they're working on. It's a great success story for Canadian real estate and a great fund to be invested in.
I might just add that the distributions, if you are getting distributions, it's very tax efficient. So it's largely treated as return of capital or capital gain. So they're basically taking income from the apartment buildings and flowing it through to investors as return of capital gain. So it's very tax effective.
So that you build on what Don was saying, essentially you'd be getting cash distributions without paying tax on them today. And then when you do go to sell, that's when you may pay some capital gains tax, which is lower than a tax on normal tax on dividends, which is over 30%. It's opportunity is around, it's an industrial REIT called Durham. I was just speaking to one of their senior executives earlier today, and they're really interesting track records. For those who may not have some exposure in this or maybe have some background here, when we talk about industrial real estate, anybody on this call, I'm sure, has bought something on Amazon through e-commerce. I find myself going less and less into actual stores and buying more online, more than ever. Amazon boxes show up at our house almost too often. But essentially what the industrial space is looking at in the middle chart there, the Durham guys have provided a bit of information on this, but essentially think of industrial warehouses, data centers, things like that. So again, as a regular active investor, when I go and just myself go invest in an industrial warehouse in Alberta, probably not. I wouldn't even know the first thing about buying something like that. But there's an opportunity here where there just isn't enough industrial space. It's one of the hottest real estate asset classes. Industrial and multifamily are two of the hottest in Canada, in fact. And so this particular fund, you're looking at something with $130 million in NAV or net asset value. They've been around since 2017. You got exposure here to Western Canada. This is also available to use your registered funds. Here you get the drip as well on your dividends, and you can actually get a 5% discount, which is even higher. They're looking for a minimum investment of $10,000 on this particular fund.
I have a question. They're asking how long is the term? I guess they were talking about Centurion, so I must have caught it a little bit later.
Sure. Both Centurion as well as this particular industrial REIT, and Don, feel free to weigh in if I'm off base here, but these are open-ended funds. And so the idea is you put the money into the fund, and then you typically have, usually it's about a 30-day redemption period. But Don, I'll let you weigh in if you had further thoughts on that.
That's absolutely right. Most of these funds will have redemption schedules that vary, and there's typically a redemption fee depending on how quickly you get out. So if Centurion, for instance, you can get out anytime with 30 days notice. If you get out in the first year, it's a 3-year penalty, second year, 2%, and third year, 1%. And after that, there's no redemption penalty. So if you're looking at an investment that's doing 9 to 12% and you need your money and you pay a 2% fee, you're still ahead of the game.
I have another question from Malai asking, just to clarify, the pref return is above the target return.
No.
They're talking about the Durham Industrial REIT, where it's saying target return is 8 to 12% and return with 7% target pref return.
The pref return is part of the target. So
Yeah,
it's not, you don't add on top. It is within the 9 to 12. So the pref return. So we say pref return or preferred return for short. What that means is before the sponsor, or in this case, Durham, gets paid, they're making sure investors get paid. It's almost like an order of precedence or who gets paid first. It gives you a bit of the way I look at it, and Don, feel free to weigh in if you got more experience than me on this stuff. But the way I look at it is, I think the pref return is almost my downside. At worst, I'm going to get my 7%, but these guys are actually targeting higher than that.
Don, any comments?
Most of these funds will have, they wouldn't always call it a pref return, they call it a distribution. So in Durham's case, it might be the point where they participate in profits. So once investors have made 7%, then they'll share in profits. In most cases, like Centurion will advertise annual distributions of 4%. and a target return of 7 to 12. And that means they will pay you 4% a year in cash, and then you can expect another 4 to 8% in growth in the asset value of the fund. Correct.
All right. Kaz, you want to finish off on talking about the drip plan for industrial?
Yeah, and this one is a really interesting one because you've got the 5% discount. So it's even juicier than the Centuria one. Again, different asset class, but being able to grab additional units at a pretty substantial discount over the current NAV. NAV is net asset value, essentially what the price per share is or per unit. The NAV grows, the underlying assets in that fund grow over time.
All right. And the minimum investment for this fund is $10,000, but they're willing to discount it to $7,000 if you're using TFSA. And funny enough, it corresponds exactly with what the limit is for 2025.
So the next one is really around what we call a MIC for short, Mortgage Investment Corporation. I think the diagram in the middle left there is probably the best way to think about this. This sponsor's name is Ginkgo. They're based here out of Toronto. They basically will lend mortgages. I think it was roughly just over 11% rate on average for the portfolio. And then those particular borrowers will make interest payments, repayment the mortgage. And then you as an investor essentially are receiving the cash upstream to you as a dividend. They're looking for a targeted return to you as an investor of 9%. They've got a drip program as well. Instead of receiving those dividend payments in cash, you can simply buy additional units. And this is also registered funds available. They're looking for a minimum of $10,000 per investor. $180 million size of the portfolio. Particularly about this, if you look at the middle right there, 66% leverage. In other words, when you think about the value of the homes or the residential properties that they're lending against, they're only borrowing about 66%. So meaning that they're far more secured. One of the biggest concerns people may have is, hey, I'm lending money. How do I ensure that person I'm lending to is going to pay us back? And so part of their track record at the top there is they've paid over $50 million in dividends since inception.
I might just add, Kaz, that MICs in general do 1-year loans. So this is not a permanent financing solution. They're usually bridging borrowers to a more permanent, lower cost financing solution. So you got a portfolio of 1-year loans means the average portfolio duration is only about 6 months. So what that means is they can adjust to market conditions very quickly, and they're constantly turning the portfolio over. It really helps them manage
risk. If you look again, the top right-hand corner of that table, the largest loan is less than 1% of the portfolio. What that tells you as an investor concerned about with mortgages is what we call concentration risk. So if 50% of that 180 million was one borrower, you're all in on that one borrower. And in this case, they've got a pretty well diversified almost 500 loans there that make up this current portfolio. This is as of November 2024 financials that I pulled up in prep for this.
Yeah, it's good to note that the average loan size on this one is $376,000.
Number 4, if you want to be part of addressing some of the housing crisis in Canada, you have an opportunity to be able to participate in probably one of the most beautiful places in Canada, which is just out near Victoria, BC. That's an opportunity where $134 million government in beautiful Langford, BC. There's an opportunity there to be able to benefit from significant returns here. They're looking here now, this helps address the earlier question. This is a 36-month approximate timeline. So with a lot of development projects, your money is difficult to come out if you can even get it out, to be honest with you. You really need to lock in those funds for the next 2 or 3 years. Again, if you think about what we were talking about earlier about your overall portfolio, this is something where if you need to redeem in the next 2 or 3 years, it's not advisable to use that cash for something like this. Having said that, because your money is locked in longer, and the reason being they've got to build these towers, clearly they need cash in the project to be able to get the financing and complete the work. You have an opportunity here to be able to generate a 55% return on your investment with a pref return as well.
Yeah, we've been longtime partners with North America Home Finance, and in this case, pref return means exactly that. So when the condos are all sold, it's what we call a waterfall, which really means how the profits are and the funds are distributed. So first funds are to pay our investors back 100% of their investment. Then they receive their 9.6% per year preferred return. Then the GP gets their capital back, and then there's a 70-30 split. The other thing that's interesting about this is NAHF always structures their transactions with security. So typically, when you're investing in a development, you're investing side by side with the developer, and you're taking the same risk, and you're on the same plane, which is good. And we would typically look for the developer to put in 10 to 20% of the equity. That's a normal development finance deal in a normal capital stack. In this case, the developer's putting in 50% of the equity, and we have a collateral mortgage so that our investors actually rank senior to them. So they actually rank, if there's anything goes wrong, their $9 million is behind our investors. So there's a lot of downside protection. And this project is well advanced. We're only financing the first phase right now, but they've got development permits for the first 2 phases. They have CMHC approval for the construction financing. Everything has fallen into place quite nicely.
And is this a condo or a rental project?
It's condo.
So one thing that I would point out for anybody who's a real estate agent, and if you've ever wondered how these top producing pre-construction guys always figure out where the next project is and how they get their foot in the door, this is how they do it. So a lot of real estate agents will actually invest into developments like these alongside the developer, and then the developer will give them a first crack at it when it's ready to come to market. And you actually know a lot of the information about the project, when it's going to be completed, and you're able to guide your own clients a lot better that way too.
I'll point out one other aspect of this project that I really quite is we're big at Waverley, and that housing chart and that housing deficit strikes home with us. So we're all about having affordable housing. So in the two bedroom units in this, there's actually a lock-off suite. So when you come in from the hallway, you go into a vestibule where there's 2 other doors. So one goes into the main apartment, which is a typical 1-bedroom apartment. The other door goes into what would have been the other bedroom. So it's a bedroom with a bathroom, a little kitchen area. So the buyer of that can rent that second bedroom out, help offset they're either their own rental costs or their mortgage. And because it's part of their principal residence, it doesn't fall under BC's Airbnb laws. So they can rent it as an Airbnb as well, because it's part of your home.
That's amazing. All right. That concludes the 4 opportunities we had. For anybody that is interested in learning more, book an appointment with us. You can go to cal.westcliffam.com and take a look at Kaz or my schedule and find a time that suits for you. And would love to connect. Listen to our podcast. You can go to westcliffam.com/listen. You can join our online community, win.westcliffam.com, and follow us on all social media. For anybody that wants a copy of the slide, text the word slides to 647-799-2264. The system will ask you a couple of questions like your name and your email address. You should be in our system, but I'm just trying to make sure I capture everybody. Just answer those questions, and the slides will be sent out to you by tomorrow.
I appreciate everybody joining us tonight. I know it's a little after hours, but I'm glad to get some great engagement from participants, and look forward to hearing more. If you have questions, you know where to find us. Addy's given all our coordinates up. Appreciate you, Don, coming on, joining us tonight.
Thanks for having me.
Thanks, Marty, for joining. This webinar is for informational and educational purposes only. Even though we're professionals, any advice that we have given may not apply to your circumstances. Always consult with a professional before making any investment decisions. Thank you very much for joining. Really appreciate you guys. Looking forward to connecting with you on the next one. Thank you and take care.